Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now, this week was a tale of two stories. What actually changed the story near the end of this week? What made it go from one direction to another direction? And we're talking about the markets, of course. Another incredible jobs report that came out and beat expectations, whatever you want to call it. However, the market's jubilee on Friday after that report was actually not enough to offset the losses that we piled up earlier in the week because of tensions around our rising commodity prices, which you know about if you've gone to the gas station lately. They've certainly helped energy stocks, but have started to hurt us a little more in our pocketbook as it relates to those gasoline prices. And probably the larger thing that's been weighing down the markets, maybe some geopolitical stuff, but also the Federal Reserve's potential lack of ability to make rate cuts happen this year. Now, this is something we talked about on our Question of the Week video last week. What is the justification to invigorating the economy, to juicing up the economy with lower rates, which is what that does. It juices up the economy when the economy is already running at a really good inflation, and inflation is actually not coming down as quickly as we wanted it to. Although many folks have mentioned and talked a lot about going from 9% on inflation to 3% is a lot easier than dropping it from 3 to 2. That last 1% is really tough. And that's, of course, the Fed's preferred inflation gauge. However, the Fed did get their perfect jobs report that we'll talk about in point number 2. So let's see if that gives the market the juice to continue this solid year as we've going to now go into the second week of the second quarter. Now, let's first look at the Atlanta Fed's GDP Now model to get a real gauge into the growth of our economy in real time. The last update to this was Thursday of this week. Therefore, the impressive jobs number and the positive revisions to previous months were not actually calculated in the most recent Atlanta Fed number. Yet it did increase from last week, decrease from earlier this week. It gets 2 updates a week. And the increase from last week, the decrease from earlier this week, the number now stands at 2.5% expected growth for the economy in the first quarter of 2024. And there were economic releases that went into that number from the Census Bureau and the U.S. Bureau of Economic Analysis. The actual number, the actual GDP number, is set to be released on April 25th at 8:30 a.m., so we'll get a few more of these readings from the Atlanta Fed's GDP Now before the actual number for this quarter is released. And we start to remember, or we should remember, that these numbers are highly accurate the closer we get to the actual GDP number. The Atlanta Fed's number is highly accurate the closer we get to the actual release of GDP. So a 2.5% number this late in the quarter is a wonderful development. Now, let's check in on our theory that mortgage rates can be a driver of growth and cash flow freedom for the consumer in 2024. The current rate on a 30-year mortgage went a tick up this week, not what we wanted to see, to 6.82%. Interestingly, though, the 15-year mortgage did the exact opposite, and it took a tick down to reach 6.06 for the week. Now, how about the front of the labor market, which is those that are forced to leave it by going on unemployment insurance? The initial claims for unemployment insurance, which is those going on unemployment for the first time, this week reached 221,000. So a slight uptick here from the previous reading of 212,000. And the continuing claims, those not able to get off of unemployment insurance, that number actually dropped to 1.79 million. So a nice decrease on those numbers that had been as high as 1.86 million in the last 12 months. And finally, let's look and see how the markets reacted this week. The S&P 500, which is our proxy for growth and growth in income, but only when considered together, the S&P 500, that was negative 0.95% for the week, despite the positive day Friday after the jobs report. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, that was negative 2.84% this week. And the MSCI EFA, which is tracking all the stock markets of developed countries in the world, excluding the United States, that was negative 1.15% for the week. So the S&P 500 this week was the winner by being the lowest loser. How about point number 2? We'll talk about this jobs market that I've been referencing in point number 1. The U.S. job market exhibited wonderful resilience again in March, surpassing expectations. Employers added a robust 303,000 new jobs for the month, defying challenges posed by high interest rates, persistent inflation, and the financial stress faced by households. We've continued to do this all year, really the last 2 years. Healthcare added 72,000 jobs. Government added 71,000 new jobs. Construction added 39,000, and hospitality added 49,000 to sum up the biggest gainers. The unemployment rate declined from 3.9 to 3.8. Now, the replacement rate to keep unemployment steady is 100,000 jobs each month, new jobs each month. So my question is, with these amazing job gains, why isn't this coming down faster, the unemployment rate? Something we'll answer in point number 4. This jobs report, like the last few, have continued to signal a positive trend in employment. Employment's been one of the hottest parts of the market. Economists had initially estimated that we were only going to add 213,000 jobs this month, but the actual numbers exceeded those expectations by hitting 303. Notably, revisions to January and February payroll gains further bolstered the picture for a strong jobs market. January's figures were adjusted from 229,000 we originally reported up to 256,000, while February's actually got slightly downgraded, only 5,000, 275 to 270. Along with employment growth, wage growth also saw an uptick. Your average hourly pay increased by 12 cents for the month, reaching $34.69 on average, although this pushed down the yearly wage growth from 4.3% to 4.1%, but that does stay above the Federal Reserve's target of 3.5%, aligned with their inflation goal, meaning they think for inflation to reach 2%, one of the things they need to have happen, they need wage growth to be around 3.5%. However, to look on the bright side, Americans have benefited from pay increases outpacing inflation over the last 12 months, and that enhances your purchasing power. Point number 3, the robust job market performance may potentially now delay anticipated interest rate cuts by the Federal Reserve in 2024. One of the Federal Reserve's most outspoken governors, Neel Kashkari, said this, that he thinks that there is now a possibility in his mind that we won't see any rate cuts this year since inflation has moved sideways the last 2 months, although our research arm would be quick to point out that those last 2 months have had very strong seasonal trends in them that should be washed away in March's report. And we're going to get March's report next week on April 10th. So that's going to be very important. You'd bet we'll be talking about that next week. Kashkari had previously predicted 2 rate cuts this year before this week's interview. While the economy has gradually slowed job growth after the post-pandemic surge in 2021 and 2022, it has not declined as significantly as expected. We're still adding roughly about 200,000 positions per month during the winter, and that's usually a slower time. Factors such as unseasonably warm weather in December, low layoffs in January, we didn't have as many layoffs, and employers' reluctance to release workers because they're harder to find and pull back in contributed to sustained job gains. However, some forecasters predict that forces supporting payroll growth may slow down, resulting in fewer than 100,000 job gains by mid-year. We'll see if that comes up true. The Federal Reserve's aggressive interest rate hikes to combat inflation and the depleted COVID-related savings could play a role in all of this. On a positive note, though, a report by Goldman Sachs stated that they anticipate that a substantial influx of immigrants will boost the labor supply and contribute to hiring, so they don't think we're going to hit that 100,000 throughout the rest of this year. In summary, the U.S. job market remains resilient and wage growth continues to be a critical factor in shaping our economic dynamics right now. Watch that wage growth number. The Fed's going to closely monitor those trends as they continue to determine what are they going to do with interest rates in the coming months. June, still 50-50 chance that we're going to lower rates. And finally, point number 4. Typically, economists look at the concept of a natural or a break-even job growth, which is the number of new jobs needed to absorb the new entrants into the labor market due to population growth and replacing workers who are actually leaving the workforce due to retirement or maybe some other reasons, health or otherwise. In the United States, for example, economists estimate that the economy needs to create roughly 100,000 to 150,000 jobs per month on average to keep up with population growth, to keep the unemployment rate steady. This estimate accounts for factors such as fertility rates, immigration levels, and labor force participation trends. How many people actually want to work? However, the specific number can vary based on any sort of demographic trends and other economic dynamics. Demographics equal destiny. However, the economy, as we learned in point number 2, has been consistently producing more, much more, than the 100,000 to 150,000 new jobs needed to keep unemployment rate flat. And the unemployment rate has actually gone up over the last few months' reports, notwithstanding this report that did see it drop a little bit. Now, how can this be? We're creating more jobs than the break-even number, yet we're not seeing unemployment rate go lower. Well, there are two main theories out there right now. The first, which I'm going to basically talk about, the second one we won't spend much time on at all, but the first is very interesting, and I think the one that probably is the reality. Immigration is one of the reasons you have seen large job gains with little drift downward in the unemployment rate, and additionally why these consistent, strong job gains have not overheated the economy. The reason that all this immigration is not being counted in the normal break-even number, well, you guessed it, it's the hottest political topic right now. The millions of migrants who have crossed the southern border, which has taken what the U.S. Census Bureau thought would be about 0.5% population growth in 2023 and moved it to 0.9% growth, according to the Congressional Budget Office. With the increase in immigration, some economists have estimated it might now take that break-even number that we talked about earlier from anywhere 160,000 to 230,000 new jobs per month to keep the unemployment rate flat. Now, population growth is good. Remember, demographics equal destiny. As a matter of fact, Goldman Sachs economists, like we talked about earlier, they raised their 2024 job and GDP estimates to account for this surge at the southern border, which has led to all this population growth. We just need to make sure it's legal immigration, and that's the real problem here, as opposed to the chaos theory happening down there right now, which is ripe for bad actors to enter the country through the lack of law and order down there. The other theory, which is not as realistic in my mind, is that there's a problem with our data collection. And while there may be errors in the data collection, or it's certainly not perfect, it is the scenario we've used for a long time. So if it's wrong now, why wasn't it wrong in the past? So I don't think the data collection is the problem we're running into here. I think it's the fact that we have much more immigration than we're legally counting. And the CBO, the Congressional Budget Office, got it right. We basically doubled the amount of immigration we thought we were going to have, which again is good in some ways. Those people come and take jobs in America that we are creating. We're creating these jobs. Somebody's got to take them. Otherwise, you'll overheat the economy. We'll all make $1 billion an hour, and that's actually no good when it's too hot. Okay, so you want the not too hot, not too cool. You want to be right in the middle there. You want to be lukewarm as it relates to the economy, exactly what Jesus told you not to be as a Christian. Do not be lukewarm. But the economy, if we get too hot, that could be bad. Get too cold, that it could be bad. We want to be right in the middle. And that's why you need population growth and legal immigration if you're not reproducing at a rate that will sustain your population growth. The good news is there's something about America that everybody wants to come to. So we don't have problems getting people to come to America. We know that. That is actually probably the reason why President Biden will not be reelected this year, is because he hasn't been able to control that. Control that, you get two things. You get a population that feels good about their immigration, and you get economic growth. So thanks so much for watching the What We Learned in the Markets This Week video. If you enjoyed what you watched, would you do us a favor? You can do us a favor by hitting the like button and the subscribe button. The like button helps push our content out to more people with YouTube, Google, and Rumble's algorithms, as well as the subscribe button allows our content to be pushed out to you as soon as we release it, so you can be one of the first to watch any of our video series. As well as if you would like to meet with any of our financial advisors or coaches, our coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, and live debt free, or our financial advisors and planners who help you in baby steps 4, 5, 6, and 7, start saving for retirement, get college funded, and pay off that house early. so you can eventually get to baby step 7 where you can live and give like no one else, please go to the comments section and you can hit that link down there. That'll push you right to our scheduling software. Thanks so much. We'll look forward to seeing you next week.